Good afternoon. On behalf of the team here at American AgCredit, I'd like to welcome all the folks on the call to our Harvesting Value webinar series. Today, we're going to be focusing on an interest rate update. I know we've all been listening to the news and all the excitement around rates and markets and everything in between. And so our topic is very, very timely today to address this important topic and discuss in more detail the economics behind the interest rates and where they're at today. Before we start, a couple of housekeeping items. The Q&A feature is disabled for the call today, so we ask that, the chat function is disabled today for our call. And so we ask that folks use the Q&A function throughout the call. If you have a question, throw it into that Q&A function. And at the end of the call, we will take some time to address as many of those questions as possible. We also ask our folks on the call to visit agloan.com /harvesting value, and you'll find additional resources and educational material to help you run your operation more effectively. So with that, let's jump into today's topic on an interest rate update. Before we start, I'd just like to introduce myself. My name is Marc Busalacchi, and I'm the Executive Head of Customer Strategy and Relationship Management here at American AgCredit. I get the pleasure of working with all of the teams that get to support you on an everyday basis, running your operation and being advisors to your operations as you work through the cycles and the ups and downs of the ag industry that we work with. So pleasure to be with all of you today. And it's a pleasure to introduce Matt Clark. If you haven't heard Matt Clark before, he does a phenomenal job of making complex economics feel very, very real and easy to understand. And so we appreciate Matt joining us. He's part of Terrain. He's a senior rural economy analyst, and he's going to be the bulk of our presentation today. So with that, Matt, I'm going to throw it over to you.
Thanks, Mark, and thanks everybody for joining. I really appreciate it. I know there's no shortage of things going on at the moment, so I really appreciate everyone taking the time to jump in. I titled this presentation Guessing, Speculating, and Assuming as sort of a tongue-in-cheek comment. If you listen to Jay Powell at the FOMC kind of press conference here last week, there was an interesting exchange where a reporter said, hey, look, you're telling me the economy is doing really well, but we can still cut rates a little bit. We've got wars. We've got all these other things going on. How do you come to this conclusion? And he said, we don't guess, we don't speculate, and we don't assume. And so I tongue-in-cheek titled this Guessing, Speculating, and Assuming, because my goal today is to kind of walk through where I think we are from an economic standpoint, why I think the Fed has made the decisions that they've made, and then I'll do just a tiny bit of speculating here at the end, just kind of where I think things will play out here over the course of the short term, maybe next 6 months or so, and we'll wrap that up, and Mark and I will have a Q&A period where maybe we can kind of talk kind of hear from you guys and talk through your questions. So the first slide I'd want to show you is sort of it's a way to capture why I think we had this period where the Fed was telling us the economy was well, but we had these questions like the reporter asked, and you heard Jay Powell answer, hey, we don't speculate, we don't guess, we don't assume. How I would classify this is that we have a little bit of a mixed vibe from an economic standpoint. So the chart you're looking at here is taking three things, and it's asking basically how bad are they altogether. So the blue line is just a simple Google Trends search, how many times the word recession is showing up in the news, okay? When it's at 100, it means it's showing up in the news more than any other time, which if you look at this chart, that happened all the way back in the Great Recession, which of course makes sense because we were in the Great Recession, so it was showing up the most, okay? The kind of green line is what's called the misery index. And this is just simply the unemployment rate plus the headline inflation rate, or the misery index. When it's high, it means unemployment and inflation are high. When it's low, it means they're low. Here on this chart, again, when it's high, it means the misery, quote unquote, is high, okay? And then the purple line is the percentage of consumers that are reporting worse financial conditions compared to a year ago. It's coming from the University of Michigan. So you've got a survey, you've got some really softish kind of data in this recession news, and then you have the misery index, which is the harder data. You'll notice for a really long period of time, these numbers kind of went together. Specifically between those two gray bars, which are the recessions, you have the misery index going down, meaning unemployment and inflation are going down. Consumers are generally reporting better financial conditions, so the green and purple line move together, and you don't see the word recession show up too often. Okay, well, that all kind of makes sense together. However, if you look at about the last year or so of this data, that correlation doesn't hold quite as tight. So while the misery index is going down, that is to say unemployment is generally pretty good or generally fully employed, you have inflation that's starting to abate slightly. The word recession is showing up less in the news. That blue line is going down. But look at that purple line. And the big difference where you still have many consumers reporting that their financial condition is worse than a year ago. Keep that in your mind. We're going to come back to that in a second. But what's odd about this is if you look at the headline data, and again, this is if you go back to Jay Powell's comment, the headline data is pretty good. So in the slide you're going to see here in a second, you're looking at kind of two measures that I think are the broadest measures of general economic performance. So the first is the green line, where I'm taking the average real gross domestic product and gross domestic income, which are similar calculations, but slightly different. They're both intended to get an idea of total economic production, total economic income, total economic output. If you look at those two numbers, we've really had a decent run here, specifically the last 2 quarters. You think about where the line is ending there, the last 2 quarters, or the first 3 quarters, if you will, of 2024 is right about where we would have expected it in between the Great Recession and COVID period. Okay, looks fairly good, fairly consistent, probably a little bit above trend if we're honest, which is good. Likewise, that kind of light blue line there, that's the weekly economic index that the New York Fed puts out. It's one I like to follow quite a bit. It is trying to get an idea of all of the economic data that's coming in. Is it relatively positive or not positive? Is it supporting GDP? Is it supporting growth? Or is it taking away? Again, if you notice, the blue lines here recently over the last 8-ish months have been really pretty good, kind of right on par with where we would expect an economy that's still expanding. Those are the headline numbers that we often read and we hear. But again, if we look at the survey results, they're very different. Here's one that caught my eye, and I know there's a lot of them that are out there, and we could spend all day talking about survey results, but this one really made me stop and think a little bit. This is a Gallup poll, and it's asking consumers, are you and your family better off financially in the context today than you were 4 years ago? Are you better or worse today than you were 4 years ago financially? In September, more than 50% of consumers said that they were worse off than they were 4 years ago. What was going on 4 years ago? This is a webinar you can't answer, sorry. Rhetorical question. What was going on? It was COVID, right? September 2020, we were still in the heart of COVID. Yet when consumers are asked to look back, they're saying we're worse off. And that's hard because all of the earlier data I just showed you, the big headline data, looks relatively pretty good. If we were to compare where we were from a headline data, September 2024 to 4 years ago, we would say, the economy's expanded quite rapidly, comparatively speaking. I think what's important here and why the Fed has made the decisions they've made and the comments they made is this next slide where we can kind of crack this onion or peel this onion back one little part. You'll remember I told you to think about that data that said the consumers are worse off today. Very first slide I showed you compared to a year ago. If you divide that sentiment, if you will, by top income producers and bottom income producers, you see a very different outcome. So in purple there, you see the index of current financial situation, the one I just showed you at the beginning, but that 60 represents the score of the bottom third income earners. Very low score historically. Comparatively, the top third income earners are above 100. Overall, a very high score. Why is that? Well, if you think about the way the economy has behaved in this chart to the right, we've had a really prolonged period of asset appreciation. A way to think about it is just to take some things like the S&P 500 in green, or home prices. We could throw in some other we could look at Dow Jones or some other assets. Most of those have appreciated quite strongly, particularly over the last, I would say, 12 to 24 months. We've had a really, really strong appreciation rate. That's been less true of median income earning. So think about that purple line there. That's the median weekly wages. So just a way to look at the middle income earners. So not that 60 or the 106, but the middle one. And compare that to the yellow line, which is the CPI over the same period of time. Notice the difference between that yellow line and the purple line. Notice that it's very tight. It's going to be more tight if you think about the bottom third income earners. In fact, and you could say for that bottom third income earners, some of them were falling behind inflation. That's why you see this big divergence in views, why you see maybe the misery index going down, but still a large chunk of our Americans aren't feeling the general headline data, particularly if you are on the side that doesn't own some of these hard assets. You haven't enjoyed the same appreciation as others, which is probably why we see the big difference between surveys and the headline data, which has been very positive. In this one example here, I highlight that period when in 2022, we saw quite a big decline in the Dow Jones and other stock markets. Here it's the S&P. You'll notice that is the only time that bottom third consumer sentiment has been greater than the top third. Just highlighting the fact that the asset appreciation, highlighting the fact that the top income earners are experiencing something very differently than the bottom third. That's certainly an area that is concerned, and it's more of a fiscal policy. But if you're the Fed, that's a little bit hard, because the Fed doesn't necessarily have a great analog for dealing with rates like this. The Fed has one tool, and they're going to use that tool, and that's interest rates. And they're going to use that tool for their dual mandate, which is unemployment and inflation. If you were to hear a Fed talk and you listen to Jay Powell, for example, he'll always come back to the fact that our goal is economic stability through our dual mandate, which is maintain maximum unemployment rate, and stable prices, inflation. So while we can certainly sympathize that there's some big differences right now in how we view the economy and how we're experiencing the economy, from the Fed side, they've made their decisions based on this headline data that, for the most part, is pointing them to a scenario of decent economic prosperity, abating inflation, and pretty full employment situation. That's why they've cut rates. They've lowered their rates a little bit, and it's why they gave the guidance they gave. The big question going forward is, how far can they cut rates? And from this chart, you kind of begin to get the idea that there isn't necessarily a clear answer to how much further they can cut. They've already cut about 75 basis points. If you were to go out in the markets, which we'll talk about today, it looks like some, but I would caution everybody from this chart to be careful on how far we think the Fed will cut. Historically, the Fed has cut interest rates, which is the gray bars. Think of the gray bars under a couple scenarios. One, when we're in a recession, red line, obviously a recession, Fed cuts line, or periods where unemployment is rising and inflation is low. If you look at where we are today, inflation has largely flattened, and unemployment is still historically fairly low. So there isn't a good analog for how far the Fed will cut rates. I'm going to take just a little bit here to give kind of my view on where we think we're going to go, but that really, really depends on where we think inflation and unemployment will go. So let's talk about inflation. I would characterize inflation in two ways. There's the trend and there's the level. The trend of inflation has been pretty good. So today we got a CPI report. Came in mostly how we expected, somewhat flat, but also some areas that showed some progress. When I look at these reports, I always try to step back and I try to think about the numbers that actually matter. Okay, the numbers that actually matter. I've graphed three of them here. These are the three, in my opinion, most helpful inflation metrics. Core PCE, which is it's the PCE that is take out food and energy. So think of it that way. There's the trim mean, which takes off the top and the bottom, or the fastest moving and the slowest moving items for both the PCE and the CPI. These are the measures that you hear Fed officials talk about the most, and I think are most representative of their goal to get to that 2%, which is that kind of black line. As you can tell, we are making progress towards that goal, which is what you heard Jay Powell talk about, that inflation, while still growing, is growing slower. It's growing more consistent with their goal of 2%. They think it's going to continue to trend lower, okay? That is true, and it's why they've been able to cut rates. Why I think it's difficult to see them continue to cut rates at a really, really rapid rate is this next slide. So the trend may be positive, but the level of inflation is still difficult. So we don't necessarily experience inflation as the trend would say. We experience the level of inflation. Here's a way to think about that. This chart is the CPI report, which came out today. So Consumer Price Index, which came out today. And I'm simply looking at the differences between the change from 1 year ago, which is reported in the news. Again, fairly flat, ticked up a little bit, nothing to worry about. That's the blue line. And then I'm looking at the difference between 2 years, 3 years, 4 years ago. So that last period there in green would say, what was inflation current October compared to October 2020? Again, this is where we see the broad base of goods is still 20+% higher than it used to be. That's how we experience inflation. And that's why it's difficult for the Fed to come through and say inflation is abating, but yet it's still experientially difficult. It's still hard on many of our earners. So they have to continue to keep rates somewhat higher to beat down not only the pace of inflation, but that experience or that level of inflation that we feel as consumers. That's the inflation side of the story. Let's turn now to the unemployment side of the story, which again is somewhat of a mixed bag. If you remember and wind the clock back a little ways here, we had a jobs report that was less than stellar. We had 12,000 jobs in October. Now, that report comes with some pretty big caveats. We had 2 hurricanes in Florida. We had a number of strikes, Boeing being the largest ones, port strikes, some other ones that really made that data difficult to think through. That data also comes on the heel of a blowout jobs report in September that was 250,000 jobs plus, okay? So we have to weigh these things together. This is the chart that I like to think about the most. This is consecutive months of growing the private job sector. So this takes out the government side of it, which can be somewhat seasonal and it can depend on various factors that are going on in the government. This is just private job growth. So it's from a period of when private job growth starts and resumes again. How long did we go? That green line is where we've been since January 2021, which ended then in September, okay? Again, a very strong period where we grew very, very strongly. Now that's coming off some lows, but very similar to some of our other previous excellent job growth periods. That has slowed. It has slowed. We are no longer in that kind of growth mode. Some of that may be due to October with the hurricanes. Some of it may be due to Boeing strikes and others, but it has slowed a little bit. However, if we think about it kind of as a whole and how the job market's going, this next slide gives you an idea of just comparatively to history. This is the beverage curve. It's kind of a way to think about how real, quote unquote, the job market is. So on the bottom, kind of horizontal axis is the unemployment rate. And on the vertical axis here is the total number of jobs that are available. So jobs that are posted or available to apply for, divided by unemployed people, okay? Divided by unemployed people. Right now, most recent data is 1.08 jobs per unemployed person. I think that's going to fall a little bit, and we're at about 4.1% unemployment rate. Again, I think that's going to change a little bit. My guess is when we get the next report, we're going to be somewhere around 1.04 jobs or so per unemployed person. We'll probably see unemployment rate tick up a little bit. But what I really want you to draw your eyes to is those green dots. If you think about pre-COVID, this relationship was very consistent. It was the the blue dots, which had this nice kind of smooth curve. When jobs available to unemployed went up, there was more jobs available, unemployment went down. It all kind of made sense. COVID hit, which is the red dots, and things got really weird. Got really weird. One, there were no jobs available, had high unemployment. Then we swung the other pendulum. There were jobs everywhere. We had real low unemployment. The relationship was very difficult, or it didn't quite make sense. It was harder to track how the job market was actually functioning. The green dots are how we've been doing since January 2023, and I've circled here the last several months, which again is starting to show a better relationship or a more common relationship. That is to say that I think if you're the Fed and you've made the decisions you've made, primarily because you feel that the job market has weakened some, but is still close-ish to where they need to be. So the Fed is not cutting rates 50, 60, or 75, 100 basis point shots. They did a 50 early. This last one, they did a 25 basis point cut. And they've already started signaling, hey, going forward, it's not going to be aggressive. That is to say, they've gone down slower than they went up, in part because the job market is fairly stable, but is starting to show some signs of cooling. So that's the decisions that the Fed has made. The real question is, where do they go forward? And that's a bit of a mixed bag. It's a bit of a mixed bag. If we were to wind the clock back to kind of mid-September, so here I have September 12th, if we were to look at that period of time, the market expected the Fed to go down as fast as they went up. They expected cut, cut, cut. And by mid to late 2025, they expected the Fed funds rate to be at or actually a little bit below 3%. So very rapid cuts. Now that's before we started having some of this really positive economic news, which we're going to look at here in a second. Okay. Now over the last several months, we've gotten positive economic news. Inflation hasn't slowed quite as fast as we thought. The labor market is still a little bit stronger than we thought, but cooling. And the market, as of yesterday, so just several months forward from September, and purple here, doesn't expect the Fed to go down nearly as fast as they once did. So now you're looking at a Fed funds rate around 4% by mid to late 2025. So again, this is to say that as the news has come in better than we expected, not matching the vibes, or the survey results, which are worse, we generally have a Fed that's going down less aggressively according to the market. Now, the difference here has been the Treasury market. It's important to remember that the Fed affects short-term rates and to a lesser degree, long-term rates. Long-term rates, so if you're thinking about buying like some farmland and you're trying to price maybe a 10, 15, 20-year loan, those are going to be more reflective of long-term treasuries. Those act somewhat differently than short-term rates, which the Fed has control over. Okay. Here's a chart to illustrate what's gone on in the longer-term rates, which again are responding to this positive economic news. If you think about how the 10 and 5-year, which is in the yellow and blue, have acted, probably in June, July, early August, you started to get whispers that the economy wasn't doing quite as well as we thought. We were getting all these negative surveys coming in. The Fed was saying, hey, we're going to have to start cutting rates. At the Fed July meeting, they said we're cutting rates. Jay Powell had the Jackson Hole Symposium. You can see these marked here. They're cutting rates. Finally, they cut rates in September 18th. Okay. Along the path, that 5 and 10-year rate went down. So those blue and yellow lines are going down with expected Fed cuts. Okay, so they were anticipating some cuts and they were anticipating slower growth. Since that point, the economic data has really been pretty good. The September jobs report, again, I mentioned it, 250,000 plus jobs came in. Real surprise. You can see the 5 and 10-year rate chunking up. Retail sales reports came in, again, very strong. Q3 GDP came in and gross domestic income came in, very strong. Personal income numbers came in, very strong. We had a Fed decision that was widely expected to be 25 basis point cuts, went about like we expected. We had a very quick election period, again. All of those things pointed towards generically growth that is not as slow as we thought it would be. Or there was no major disruption with elections or the Fed. As a result, those 5, 10-year prices have not come down. They've actually accelerated quite a bit. We've probably gained about 70 to 80 basis points since the Fed cut in September 18th. The market then would be telling you that longer term growth looks fairly solid, which is going to lead to some higher long-term rates, some higher long-term rates. So if you're thinking the differences here, your short-term rates on like your operating notes are likely to go down some with the Fed, or at least be a little bit lower than they were a year ago. However, your longer-term rates may not be down nearly as much as we once thought they would be. So that would be the difference. Now, if you're asking me, Matt, crystal ball it, let's look out there. What are some things that could really change your outlook here? What are the great rhinos, or which would be the things that we all see but we don't talk about, or what would be the black swans? I don't know any more than anybody else would. If I were to take a guess, I'd probably just be wrong at this. Things I'm looking for are mostly global issues. Here's one that I'm pointing out here. This is a map of the world, and it's color coded by government debt to GDP. You don't want to be red or orange in this chart. This is a time to be green. So this would indicate if you are red, your government debt to GDP is above 100. So highlighting this or leading the front here is Japan. They're like 250% debt to GDP. US, unfortunately, red, about 120% debt to GDP. You can see most of Europe, China, India, large parts of South America are in that period where they're at or above 100% debt to GDP. That is a problem. As rates stay higher, that takes away the amount of fiscal stimulus that can be issued across the world or battle off the next major crisis that we will. We've also got, obviously, 2 regional wars still going on. I guess to say this, what are the gray rhinos or black swans? To me, it's probably some sort of geopolitical thing that happens outside the US that really kind of shoves us into a different economic state, causes us to think differently about where we may be going from a rate standpoint. Anything that would be deflationary, or anything that would point towards a period of slower economic growth globally could help lower those interest rates from the Fed, could make them be more accommodative. If there's something that's maybe disrupts supply lines, or something that's inflationary, that would probably have the opposite effect. It would probably force the Fed to keep rates higher longer. So those are the things I'm kind of looking out for. In the near term, from a US standpoint, I think we're fairly good. Most of the data that's come in has been very supportive, and I'm talking micro data, high frequency data. It's coming in on a weekly basis. All looks very accommodative. At the end of the week here, on Friday, we'll get some retail sales report. Largely, so far, most of the trackers point to being pretty good. Q4 GDP, or fourth quarter GDP, again, looks to be around 2%, maybe a little bit better by most trackers I follow, which is going to be a fairly positive economic situation for the year, which is good. We all want that. But it does mean that we probably don't see the extent of rate cuts that we maybe thought we would only a handful of months ago. So let's wrap this up here kind of in a nutshell. Things I'm thinking about, the balcony level data, pretty good. Now, that's not representative of everyone, and we need to be sensitive to that and certainly compassionate towards that not everyone has experienced sort of the economic boom, and you clearly see that in survey results. Looking past the next 6-ish months, I'm not betting the farm on anything. I would still say from a global standpoint, there's challenges, which is probably where I would see the next major challenge coming, if there is one, to kind of the US GDP in the near term, or even over the next year or so. I do expect the Fed to remain accommodative. That means the Fed is going to follow the data. If inflation continues to trend down somewhat, and if the labor market continues to cool, I expect the Fed to cut a little. I just don't think we're going to see I don't think we will see the Fed go down as fast as they came up, which I know is difficult for those of us that borrow money, including myself into that. That's difficult. But I do think there will be some accommodative measures here, whether that's at the December meeting or going into the early parts of 2025. I do think you could see the Fed cut a little bit further. Now, long-term rates will act very differently. They will do their own thing. They will respond to long-term economic growth projections from the US. They'll respond to things like government debt to GDP. They'll respond to things like total available treasuries, total available buyers. They'll do their own thing. If I were to make kind of a big, broad recommendation here, it would be the last point. Think about pricing rates just like you do any of the commodities that you sell. You need to have a strike point. That is to say, if you've been floating out there, if you've got floating rates and you're thinking about fixing, make sure to be working with your farm credit lender and just be talking to them like, hey, these are kind of rates where I'd feel comfortable fixing it at. Or, hey, I really would feel comfortable floating, but if there's some of these kind of options that come up, let me know if it hits this. Or if I've got some land coming up for sale that I know I want to bid in, it's a really good time to have those one-on-ones with your farm credit loan officer. Talk through, hey, this is what I'm thinking. What are the options? Because product mixes will make a really big difference. There's no kind of one solution fits all here. You need to really be thinking about these carefully with your cash flow considerations, your prices, and have that strike price in your mind, have that conversation ready to go with your lender to know what kind of rates they're thinking about and seeing, and be in good constant communication because things will change, outlooks will change. But for the moment, it probably feels like we're still going to be, we aren't going to be where we were 5-6 years ago at extremely low rates in my personal view anytime soon, unless there's some sort of big black swan that hits us. So that's where I'm at today. I'm going to turn it over here to Marc, and we're going to try to answer questions. And I realize this is a topic that invokes a lot of questions. So we're here. I've got nothing else on my calendar other than writing things, which I really don't want to do any write-ups or reports. So I will stay on as long as we need to answer questions.
Perfect, Matt. And we'll give them a few minutes to use that Q&A function to put some questions in there. Matt loves questions. He's a wealth of knowledge, and we'll get to those. But again, before we do that, and I think Matt touched on it really, really well. We need to think about, as a customer of American Ag Credit, what are the things that I should be considering moving forward? If I have a variable rate loan or if I'm looking to refinance. And again, I think Matt alluded to it. Every situation is different, right? And so there's no two deals, no two customers, no two operations that really are the same. And so we urge you to reach out to your relationship manager, reach out to your lender, and talk through the scenarios. Talk about what your aspirations are for your operation, plans that you have, and then that'll really be kind of the differentiator in what makes sense for your operation. Relatively speaking, we are in a higher interest rate environment, right? We've seen a couple of cuts, but still compared to a few years ago, we're still, the cost of money is still a little bit higher than it used to be. So something to think about. Also, you want to look at, hey, what's my loan repricing eligibility, right? If you're in a type of loan that can be prepaid, that is a feature that you have with being a customer of American Ag Credit, is we have some really easy ways to convert you to lower pricing if the economics make sense. Other factors I think that we list here on this slide. Do you want to reduce your monthly payment? Moving to a fixed rate loan, does that make sense if you're floating on the variable right now? Do you have some consolidated debt that you'd like to put into some type of loan to improve cash flow? And then looking at that amortization, does it make sense to re-amortize potential loans that you have with us today at American Ag Credit? So again, this just scratches the surface on excuse me, things to think about. But we urge you to reach out to your lender to talk through those scenarios. Sorry, I got something in my throat there. Apologize for that. Here is my contact information. Again, I work with all of the teams across the organization, to take care of your financial needs and any other needs that we can help you with. So feel free to reach out at any time. Would love to be another advocate and partner with you here at American Ag Credit. So with that, again, opening up that Q&A function there, we'd love to hear your questions. maybe I'll kick it off, Matt, while people throw in some questions here. We hear a lot about consumer credit card debt, and I know you didn't address that in the deck today. We've talked about it previously and on other presentations that you've had. What does that mean for the overall economy? What are some what should we expect as we move into the holiday season, right? And spending continues to probably uptick there. Would love to know your thoughts there and relative to the economy.
Yeah, it's a great question, Mark. So I try to put it again in a couple buckets. One, we have to think about the level or the amount of consumer debt within real terms. What I mean by that is if you think about the rate of inflation has gone and how much, whether it's groceries or, my gosh, I just got tires recently for my truck. Bad idea. That's expensive, right? So you have to think about the level within inflation metrics. So the total level of debt is extremely high, is a little concerning. If you factor in inflation and make it the real level, it kind of brings it down to a more like, okay, I can understand why we're here. And so that's one avenue. The second part that I think is probably where I tend to focus more deeply is what's repayment been like? Okay, so two ways to think about it. What's delinquency rates, which are overall ticking higher? Okay, they're not nearly at the levels that they were in any kind of recessionary period or leading up to recession, but they are ticking higher. The New York Fed does a really good job of issuing kind of like a consumer report that breaks down debt and delinquency rates by, 18 to 25-year-olds versus 65-year-olds, bottom income earners versus top income earners. And again, it's the younger and it's the lower income brackets that are having trouble keeping up with their credit card debt. Most certainly, that's driving that number a little bit higher. Overall, though, still a little bit higher. So I'm watching if that delinquency rate goes higher. Okay, if it goes higher or gets to levels that you start to kind of squint and say, gosh, that looks similar to recessionary periods, then I'm getting concerned. Lastly, I would just say if you think about payments in terms of disposable income, they're not quite as out of bounds as we once thought they were. That is to say that, yes, the debt is higher, interest rate is higher, but wages have also appreciated really significantly over the last several years. So that ratio is, again, higher, concerning. Probably not. Not so much that I think it's going to derail the economy. Janet Yellen once had a great quote about the economy that I've thought about for a long time, and that's that economic expansions don't die of old age. They're murdered. That means something comes and just blasts us. I don't think credit card debt is what's going to slowly kill off the economy. I don't see it. Concerning, not something I think will tailspin us into a recession anytime soon.
Perfect. Thanks for that. Have a question here from our group on the call. Obviously, we had an election here in the last week or so.
I noticed that on the news.
A lot of focus around the economy, rates dropping. And again, a simple question: how do you think the new administration will impact how fast the Fed potentially cuts?
Yeah. From the Fed's, I guess I'll break this into two pieces, okay? The Fed will try to be as apolitical as they can, right? I mean, their job is to step back and ask two questions, and that's, are we at maximum employment? Do we have stable prices? If those things aren't true, what do we have to do with interest rates to get us to that point? Okay, and that's largely just going to be the inflation metrics and unemployment metrics like I showed you, and some of the other supporting data. So again, that will be the Fed's goal. For full disclosure, I'm a former Federal Reserve employee, okay? So full disclosure to everyone, that will be their goal, okay? What we'll wait for and what we don't know is what will the new policies be, okay? So once we get into 2025, we get an idea of what the policies will be. And once they start to go through the legislative approval process and we get an idea of when they will hit, then we'll start to know how that could impact inflation, or unemployment or the employment, for the good or bad. Again, anything that causes the economy to grow faster, higher rates. Anything that causes the economy to grow slower, lower rates, generically speaking. Now, what policies will do that or will be enacted? At this point, it would just be the old jump to conclusions, Matt. We don't we don't know, right? We don't, and I don't want to get in front of my skis and speculate on a whole lot of that. I'll take Jay Powell's rate on, quote on that one. But I think this is one of those things. Just anytime there's administrative change, whatever side is always trying to come out and say it's going to do X, Y, Z before we even know what's going on. I think at this point, I've realized that it's best not to get too far in front. Wait till you see what's being proposed, what's making its way through. Then you can start to kind of have some ideas to gather where we're going to go. We're a week out,
right,
in the election. A little too early.
So Matt, maybe the inverse of that, right? Rate increases potentially when you talk about inflation not being terrible, job growth, slow but not terrible. 1.8 jobs per unemployed person, strong numbers. That we've also seen some headlines that indicate maybe rates go up. What are your thoughts there?
I don't see it in the short term. I don't. I think we're at a level now that it's not accommodative to those things, meaning it's not at, whatever you want to tag the rate at, whether you want to use the Fed funds rate or the current treasury rates. I don't think any of those are prohibitive to growth or accommodative to growth. I do think we're kind of in that middle part, okay? If we go more than a year from now, or, if we start looking out 8 months from now and inflation is picking up or unemployment is going lower, we have a lot of really great growth, and I don't know what that would be, some sort of AI boom. I have no idea. If something like that really forced it, you could see the Fed do that. That would be like a 1970s-ish scenario. If you wind this clock back to February, and I did this last webinar, I said they would only cut 50 basis points in 24. I was pretty darn close. I was close, and I made mention then that they're going to move slowly because the last thing they want to do is move down quick and then have to move back up because of a lot of growth. I still think that's true today, however many months later. So I don't think it's on the table, but I don't think it's off the table. That's how I would put it. If you look at all the current Fed projections from all the FOMC, Federal Open Market Committee members, none of them have projected rate increases. But if things a year from now look like we're growing way faster than we thought and there's still inflation issues, I wouldn't say it's off the table for sure.
Great, thank you. Question that came through around government spending. So how much of the economic outlook, GDP, are reliant on government spending, and how does the newly created Department of Government Efficiency potentially impact the future economic outlook, both for jobs and GDP? And it may be too early, but would love your thoughts on that.
Yeah, there's a really good, if you go out to the Federal Reserve Bank of St. Louis, they break gross domestic products down by component, or the Bureau of Economic Analysis breaks those down by component, just like they break out job gains by components. So if you remember, I showed you only private job growth. So that does not include government growth. So you can do that with GDP too. The government is one of the larger consumers of our goods. They are one of the larger consumers of our goods. You think about the military, a very large spending complex. You think about Social Security or Medicare, Medicaid, very large consumers of products, right? So if you were to take out the government component of GDP, it's still positive. It's not negative, but it's not the 3% that we've seen here over the last few months. It's 1, or it's a chunk. It's not as robust. It's not also, I would say, outside of historical norms. Now, the government is still a big component of that. Where I'm going with this, what we don't know are the differences between efficiency. Like if you say efficiency, that's generally pro-growth, versus taking consumption out. So if you were to take some of that consumption out, the question would be how much could private consumers or private enterprises make up or do more of that same amount of consumption. So for example, if you were to cut some sort of, using this lightly, if you were to cut some sort of Medicaid portion, it's not like that's going to fall away. Will private sector pick it up? Will they pick it up more? Will they do it differently? Will they do less of it? Those are the questions we don't know. I guess just really big picture thinking on this, just really big picture, it's sort of a question of timing. If we're able to cut some and private sector picks it up and uses those resources more efficiently, it'd be pro-growth. If there was cuts, it's not picked up, the private sector doesn't use it as efficiently or in the same way or less of it, then that would be, I wouldn't say anti-growth, but it would be slower growth. We'll see about DOGE, Department of Government Efficiency, DOGE, I believe is the fun nickname it's got. We'll see. I mean, if you think about our debt to GDP ratio, which I showed you, that's very troubling. That's, I think, why we're having these conversations. Both sides of the aisle are having these conversations. If we can't get that under control, it's likely that the bond market would start to price our bonds higher and start forcing some of that control. So that's why it exists, or why it's being created, in my opinion.
Great, thank you, Matt. The next question is around tariffs and a couple of specific things around that maybe you could address. The first one being potential effect on interest rates if they're implemented. And then the second one is more specific to our neighbors to the south, the Mexican peso, and the value going forward, and what happens to, if to Mexican goods if that if tariffs were to go into put into play. So,
oh man,
couple
awesome questions. Yeah. Okay, let's start with the latter. Okay. Mexico has, for the most part, displaced China as our top trade partner for ag. Okay. Most of our commodities have wonderful, good, solid relationships with Mexico, whether that's soybeans, whether that's hogs, whether that's wheat, or maybe to a little lesser extent, some of you in California that have tree nuts probably haven't gained that market share, but it's a place I would strongly be recommending you to look. If you think about the peso, the Mexican peso, that is, it has done well coming out of COVID relative to others. So their dollar the peso has strengthened. Since their new president-elect Sheinbaum has taken office, it's been a little choppy through not only their own transition, but now we've got our own. So it's been a little bit choppy. I don't know what'll happen in terms of specific trade policy with Mexico. What I think is a bigger factor here with Mexico is two things. One, we do have a good general trade agreement, USMCA or NAFTA 2.0, that has been good for U.S. ag overall, whether that's NAFTA 1.0 or NAFTA 2.0, particularly this last reworking has been very good for ag. Okay. What's more important about Mexico is that they are a young and a growing economy, meaning their age is relatively young. Their population trend is very positive. They're a growing country, and their real GDP per capita is really doing well. They're a solid growing country. As they grow, they need U.S. ag to fulfill that growth. Okay. They can't grow all of their protein, all of their grains that they need. And that's why USMCA has been very pro-growth for U.S. ag. I think in my mind, that's the bigger factor, because that's a dynamic that's not going to change soon, right? They're going to keep growing. In my opinion, we're going to keep growing. So I think that is a bigger issue long term. In short term, maybe there's some, I don't know what policies, maybe some tiffs here and there, but overall, I would say Mexico and the US have a very bright long-term trade future. Now, the first part of the question was tariffs. And again, this is where we need to not jump to conclusions and where I'm trying to be careful. I don't know what will happen any more than anyone else did. If I did, I'd go short or go long on the market, and I'd be rich. And no offense, but I wouldn't be on the webinar. I'll be honest. I would still live in Bueller, Kansas, which is right behind me. I would still live there, but I don't know what we'll do. And again, it's easy to look at that and jump to a conclusion like this will mean that X commodity does X, but we'll do Y to the Fed funds rate. But if we roll back the clock, remember the Fed really didn't start to raise rates that high even last time under the tariffs. It got to 1.25 or something like that, 1.5 or something, in 18, and then they slowly cut it off in 19. So, again, I just don't think that affects the Fed in the same way that we think. We want it to be very binary. The Fed is going to view it through the lens of unemployment and inflation. If policies go in that are pro-growth and you start to see inflation pick up because it's pro-growth, that could slow the Fed's roll. If it goes the other way and maybe something happens, whether it's geopolitically or other, that is maybe slower growth, you could see the Fed cutting a little bit more. But the Fed isn't going to view that binary decision in the same way that we easily want to jump to. It's just too early to jump to that conclusion.
Well, we had another request to put the graph up showing the projected interest rates. And I just wanted to remind participants on the call, we will send all of this information out post-call recording, and you'll have that information. So all of that information to reference moving forward.
Can I add there real quick, Mark, just for the participants?
Yeah. Mm-hmm.
If you go into your Google search bar, you're on the internet now because you're watching this, and it's okay if you open up a Google search bar, we won't be upset, and type in CME space Fed watch tool. You can get all that same data that I showed you there. And you can, I had it updated as of yesterday. You can look at it today, and heck, I look at it every day just to kind of see what's going on. So it's a good tool. It's out there. It's free. It's helpful.
Any other resources, Matt? I know you always pepper those in for our participants, for our customers here that they may want to reference moving forward that you feel are really useful in your day to day.
Yeah, I'm always careful with how much news commentary I read, just because I want to be cognizant of the fact that economies move slower than the news wants to point it out. If you watch the news, one day we're in a recession, the next day we're not. One day we're growing at 20%, the next day everything is going bad. And that's just not, economies don't move that way, realistically. They move slower. And so I'm always careful to think about the news sources. So if you go to trainag.com, for example, we have very regular reports. We put out quarterly commodity reports for all the commodities that American AgCredit, Farm Credit Service America, others put out those. So if you're in tree nuts, or if you're in hogs, or you're in cattle, you've got quarterly reports. We also put out regular reports on what we're looking at, the data we're looking at. I'll have an interest rate one here at some point. It'll come out in addition to this. Those reports to me are a better representation, because we're not in the who shot who kind of thing. It's how are we doing? What do we think is going to happen over the next 4 months, over the next 6 months? So trainag.com is a good one. I'm obviously a little bit biased there. But I would say, too, even to the person that asked the Mexico question, Bree Botts, the grain economist, has spent a number of her reports focusing on the positive trends with Mexico. So those things are out there as a resource. And I think you can get to it to agloan.com as well.
You can.
So if you go to American AgCredit's webpage.
Absolutely, yeah. And Terrain is a partnership of ours with all of our leading industry expertise, and Matt is part of that expertise. So we appreciate all of your candor today, the information that you shared with our customers. I don't see any additional questions, but Matt and the team here at American AgCredit are always available to field questions, to get you information as your partners in your operations. And then as a reminder, again, we've recorded this information, this webinar today, and we will share that with participants after the call. And before we leave you today, again, as an employee and a team member at American AgCredit, we do really want to thank you for joining this webinar, a very timely topic. We will continue to update our customers as we see fit, kind of with the changing markets, because we know this is an important part of your relationship with American AgCredit. We continue to thank you for your business and your partnership and the trust that you give us within your operation every day. And so with that, again, thank you, Matt. Thank you, participants, for joining the call today, and we look forward to being in touch soon.